Hey everybody, Preston Brent here with our Trader User Group Weekly Financial Roundup. This is an update for the week ending September 12th, 2014. What I've got on the screen here is a daily chart of the E-mini S&P 500 futures. You can see I've used this chart many times before and will continue to use it until it doesn't work for us anymore. You can see going back into Q4 of 2012, we've been in this tight band moving up very nicely. And there's only been just a couple of times, as I pointed out previously, where the market action has actually had a day bar close outside of this band. Only 3 times. And in those 3 times, it's only lasted really this last time, this most recent time, it was outside the band for about a week. But outside of that, each one of these other times was just a day or two, and then we got back inside the band again. You can also see the 50 EMA, which is this red line as it moves up, first moved outside the band back in middle of May this summer, and then came back outside the band here, and now it's sitting actually below the band. So we're starting to get weakness as the market moves up. One other thing I wanted to show you here, as you guys know that are active followers of what we're doing in our user group, and it's worked out very well for our members so far, and for me, I'm using this to really successful results this year in trading. You can see a couple of things. One, I wanted to point out to you some similarities. We had a situation right here where we had some really good bearish divergence set up on the chart. We stayed in a tight band for a while, but we had that bearish divergence hit us, and we got short right here and just had a nice little pop to the downside. It was really the first time we closed outside the band, or this channel, upsloping channel, in over a year and a half, really, since we entered it back down here in 2012. Now, we've got something very similar here setting up. You can see we're in this tight little pattern right here, and we've got this bearish divergence setting up on these peaks. You can see we slid off and we made another attempt at a move higher. Just like we slid off here, we made another attempt to move higher, but we didn't hit the peak. From that point to this point, it's the same thing from this peak to this peak right here. So now, you generally see some commonality and some congruency in a number of different indicators, but bearish divergence is another way you can use this as well. If the same pattern holds true, we're going to find ourselves moving outside the band like we did there, somewhere down in this area here. So that would put our potential low back down below 1900. So that'd be another 75-point sell-off as we move forward. Right now, I'm going to zoom in on this real quickly for you here and show you that, in fact, with our group and what I was talking to our members about, we've now got a sell signal. And we've been cautiously bullish, by the way. I've been cautiously bullish all year. But we got our official sell signal here. We got a 50 EMA, and you can see we closed right there. So we're right on a couple of key support points right in that area there. The first one, of course, is the 50 EMA, and the other one is the upsloping trend line, or the lower half or the southern side of this upsloping channel. So we've got a number of different points here. And then we got a natural price level sitting right there that's a prior pivot high at 1960. So we've got a number of indicators or technical indicators as well as a natural price level right here at 1960 that's going to serve as support for us. Now, just as a reminder, this coming week, it's a what we call triple witching, where we've got quarterly options expiring. We got futures rolling early in the week. We've also got monthly options expiring. In a triple witching, the market tendency is to move higher, probably more so than just a normal monthly expiration series. Now, one thing that we've also got coming up this week, we got the FOMC policy statement on Wednesday. So we're going to get some volatility into the markets this week. I think it's already been bid up a little bit in anticipation of this. If we were to look at the VIX here just real quick, um, just to show you, here is the VIX. The VIX closed at 1331 on Friday. You can see the volatility has slowly been moving up since the August 25th. You can see this right in this area there, August 25th. I can draw this line like this, and you can see this upsloping channel that's clearly evident here in volatility. And the volatility started moving up in anticipation of the FOMC statement. A very, very important statement coming up. Why? Because, as I've talked to our members about this, and we've been watching this, and there's some great plays in the currency market coming up as well. And as a reminder, our members, we have our Sunday evening session tonight, and we're going to look at some of these opportunities. But we've got the FOMC policy statement, and everybody's going to be watching to see if they're going to raise their interest rates. Not now, not in this policy statement, but they're going to they're going to move forward their guidance of when they could anticipate an interest rate rise. So everybody's going to be looking at the language. Also, it's a quarterly statement, so Yellen's going to step up to the mic, and she's going to talk in a very boring, I'm going to fall asleep kind of mode. And if she says anything that the markets interpret as more hawkish, not dovish, but more hawkish as far as moving the potential for an interest rate rise sooner than later, then you're going to see more volatility pop in, and I do believe you're going to see more of a sell-off. So that would get us back down below the 1900 level, the 75 points that I talked about. But you can see interest rates. You can see the VIX has slowly been moving up. Typically, when volatility moves up, it does something like this. It doesn't really wait around. It's like a space shuttle launch, and then it works its way back down again. But in this case, this is just a steady, slow rise in vol. Now, the markets, in some respects, it does not indicate a bearish market or the coming of a bearish market. All it indicates is there's adjustments in valuations going on in case the Feds do raise their interest rates. If they do, if they indicate that the interest rates are going to go up sooner rather than later, then the big market participants, the big money, is going to start adjusting their portfolios via newer valuations of where they think the market should be. And that means a little bit of a sell-off to adjust for and account for the anticipation of a interest rate rise sooner rather than later. So this pullback that we're having is not an aggressive, open the barn door, let all the cows out into the pasture real quick. It is more of just a steady progression. I think this week, should the Feds do that and they stand more hawkish because of the good news coming out of the economy overall, I think you're going to see an acceleration to the downside and a quicker sell-off. We've also been seeing this also in the bond market. The bond market has really sold off dramatically. I mean, look at what the bond market has done. Now, we got bearish, and I told our folks I got bearish, and I'm bond futures bearish right up in that area there, and just been riding it down and getting in and out of bonds. But we've been in bonds bearish up in this area here. And I said that the bond market up in that area there deserves to be shorted. We know interest rates are going to rise. We just don't know the timing of the interest rates. And between when the interest rates finally start rising and now, bonds have moved up in anticipation of potential sell-off and a flight to safety. Because as I've told a lot of you, it's unusual to see the bond market having a good year and the equity market also having a good year, being both bullish. But we've had a lot of money flowing in from Europe. If you look at some of the European 10-year bond notes, or 10-year notes rather, especially Germany, Italy, Portugal, Spain, they're lower than our 10-year notes, treasury notes. So when the European notes are lower than ours, guess where the money's going to go? It's more safe to be over in our market. So the money comes from Europe over into our market. So that has a tendency to move the bond market up like that. But now we're at a point where we're getting this pullback in anticipation of a Ford moving the interest rates forward. And if that happens, I think you're going to continue to see a sell-off in the bond market. And as you can see in this pattern right here, what I had indicated that the bond market, by the time we get through the end of the year, is going to be somewhere in here, okay? And now, to get from this point here to this point here, it's not a straight shot down. You know, we could even go up higher, but I think we're going to end up at this point here. So for the bond shorts, you know, this could be a very good trade. It's $1,000 a point in the bond market. Same thing with the Treasury notes, $1,000 a handle. You know, and so we're looking at, we've already taken a good piece off right now. We're sitting right at the 200 EMA. We're at a key crossroad right here. If we break that, you know, this is a zone right here. You can see in this zone, it served as very good support or resistance depending on the direction of approach for price action. But now I think it may bounce a little bit of a relief rally. And for those that have not gotten short bonds or short TLT, that's another way to play this with puts if you're not into the futures market, is to take a look at this, because you can see here the 50 EMA. We sat there for about 4 or 5 days. The 50 EMA is now starting to develop a downward trajectory. And the 200 EMA is now flat like that. So we could be sandwiched between these two for a little bit until the market resolves itself. We get clarity, and then we move forward. Now, if the Feds move forward their interest rate guidance, I think you'll see a continued sell-off in the bond market, even though the interest rates are not moving up now. Because here's a classic case of it right here. If you look right in this area here, the fear back over in 2012, remember when the market started improving, was that everybody thought interest rates were going to start going up. So what did the bond market do? It finally gave it up and had a huge sell-off right in this area here, going back to 2013. I mean, just really, the bond market tanked. It gave it all up for fear that the interest rates are going to go up, inflation was going to go up, and the bond market sold off. But then when the markets realized that, well, the Feds kept saying, well, you know, don't be so hasty. Interest rates, we're going to keep them low. We're going to hold them low for quite some time. So the bond market really started that slow grind back almost at the beginning of January, right? So if I were to box in the year 2014 for you so that you can see this, you can see the year 2014. Here we go right there. That's almost right at the beginning of January, right? We entered the year at the low note of bonds in 2014. And now we're sitting right here. We've almost given back 50%. The 50% area for the bonds is right at that area right there, right at that highlighted area for the entire year. So in just a very short period of time, right there, we've given up almost the 50% of the gain for the entire year. Okay, that's how fast bonds can move. And if you're not short bonds when this move happens, by the time you turn around and click your heels twice, bonds have already made 50% of the move. That's why sometimes going short and dipping your toe in the water in some of these areas, because you don't know which pullback is going to be the big one, is generally the wise course of action. I know sometimes it can be painful because as it goes short and then it bounces up higher, goes down, bounces up higher, it can be frustrating. But that's what you've got to do. And then at one point, boom, it just finally gives it all up very quickly. Now, as it does this big move like this, I'm going to move my stops down a little bit. But I think we're going to be sandwiched between the 200 and the 50 EMA for a little bit until we get more clarity out of the Feds. Okay, so that's a little bit about the bond market. Now, if we come back up and we look at the Russell, remember I told everybody keep your eye on the Russell because it is going to be an early warning indicator here. Let me show you the Russell market. It really is amazing to me. Um, I'm going to box in 2014 for the Russell just to show you guys how this thing has been playing out. This box right here is the rut for the entire year 2014. Okay, we entered the year right there. We're sitting right there. Now, I don't know about you, but visually, you can look at this chart and say, we really, you could have just gone on vacation, hold the rut futures, and just about been flat. We entered the year there. We exited right here, right now. I mean, it's almost flat. Yet we've had these huge up moves, down moves, up moves, down moves, right? We've tested the top. We've tested the bottom. In fact, the bottom is a very strong area of support for us or resistance when we first entered it back over here. And now we're on our way back down again. I drew in these regression channels. You can see these channels right here in blue, gray, and red. These are regression channels. So you can see the severity and the ascent or descent of the slope of the rut. It's been very quick. Okay. We're now on a descent right here with the rut. We did not make it up to the highs here. Notice with the Dow and the E-minis and clearly the NASDAQ, they're all up in this area here in relation to the prior pivot high. The rut in relation to prior pivot high only made it up to this point right here. The rut is underperforming, folks. The rut is comprised of small and mid cap. This year, small and mid cap have underperformed large cap stocks, dividend paying stocks, more flight to safety type stocks. Okay. And it wasn't only until about 3 months ago that the utility sector was the best performing sector of the year of all 9 S&P sectors. Now the utility sector has given it up, just like bonds, because utilities almost trades like bonds because they're very interest rate sensitive because they're so capital intensive. Now you can see here, here's the 50 EMA of the rut. Here's the 200 EMA of rut. We're sitting right on the 50 EMA, right in that area there. If it gives it up, we're coming down to the 200 EMA of the rut. That's 1132 as we open on Monday. And then we got a number of these yellow dashed lines are natural price levels, support and resistance points. And then you can see a key pivot there. But then the mother of all pivots is right down here at about, let's call it 1080, 1078. That is what we're going to want to hold. We're going to know if the markets reverse and we get our big pullback if we break this area here. I do believe we're going to see some buyers step in at the 50 EMA. We're starting to see a little bit of buy-in come in the last half hour of trading on Friday. But keep in mind, this is triple witching. The markets tend to be naturally bullish. But to throw cold water on that, we got the FOMC policy statement coming out on Wednesday here in the U.S. All eyes are going to be on it. Okay. Now the currency market is very interesting. Both currencies and U.S. Treasuries are very volatile are in and around and leading up to and certainly right after FOMC policy statements. So we're going to watch these for some really good trades. For our members, I'll go through that tonight. If you're not a member of our group, I would highly encourage you to check us out. We're doubling our membership every year. We're growing very quickly. Thanks to a lot of you guys that are coming over into our group. Now, one other chart I want to show you here, which is very interesting, is the NASDAQ. You can see here NASDAQ has been outperforming everybody. It's in its own little world. But I do believe right here we're in this tight band, and we can be here. If this tight band gives it up, then we're going to come down and we're going to test this area here very quickly. Right around 39.50, 39.47. Call it that area right here. So let's watch this very closely. Here's the 50 EMA. We got to get through that first. If we do have a strong pullback, NASDAQ will probably give up the most, the quickest, because it's moved up the strongest. But we do want to watch the rut. We want to watch it very closely. because the rut will give us a little bit of a tell. All right, everybody, that's my quick update for this weekend. Members, I'll see you tonight. We'll go through some really, we got a number of trades that we're running right now in both the commodity market, the treasury market, and in the equity market. So let's look at them. Let's look at the week coming up and possible expectations. Have a great one, everybody. Bye now.